Thank you for those who have joined today's CCIM webinar on State of the Market. We will be starting momentarily. Thanks. Good morning, everyone. My name is Ian Grusd. I'm Senior Managing Director with the National Auction Services team at Marks & Millichap. It's our pleasure to have you join today's program and for me to kick it off as the moderator by introducing our chapter president, Brian Whitmer. Brian, good morning.
Good morning. Thank you so much. I'm Brian Whitmer, Managing Partner and Founder of RePropCo Capital Advisors, and also the current president of the CCIM New York chapter.
Thanks, Brian. It's going to be a great program today. It's my pleasure to introduce Christina Good, Senior Vice President with Ion Bank, our event sponsor. Ion is a 155-year-old mutual savings bank, and Christina is based out of their Pine Brook, New Jersey headquarters. She has more than 25 years of extensive banking experience, including managing a diverse portfolio of commercial mortgages, overseeing construction and development loans, and providing financing solutions for acquisitions, development, and refinancing of commercial properties. She also serves on the advisory board of the New Jersey Salvation Army. Christina, welcome. We're excited to get a snapshot of what's going on in the current finance markets.
Sure. Good morning, everybody. New York, CCIM New York Metro, and Ian, thank you so much for the warm welcome. I first want to thank, Brian Whitmer and former President Lee Barnes for this opportunity. I joined CCIM late last year, and just from the onset, it's been a great group to be part of. It's a great think tank, a lot of knowledge here. So I think you're going to have a great session here, learn a little bit more about receivership, and like I said, amazing panel here. We'll go over a few different asset classes. So again, I want to thank CCIM New York Metro for the opportunity to talk a little bit about Ion Bank and what's going on in the market. As Ian mentioned, Ion is a 155-year-old mutual savings bank. The benefit of a mutual is there are no stockholders. So all the profits and benefits and gains of the bank get reinvested back through products and services, competitive rates, and it allows us to keep the focus on the client. I would say I've been here about 2 years now. I came over with my team lead, Al Noonan, and my CRE underwriter, Jay Piznicka. We were formerly with one of the top 3 banks. We were there together almost 15 years. So when we came over, it was a really nice plug and play. It really was just learning and adopting the Ion culture, which I got to say is just a really nice entree, especially for this timing and what's going on in the climate. More banks are coming online, and having a bank like Ion, you really do get personalized service. We have just great access to senior leadership, and we have structure, which I think is important. I think everybody can appreciate speed to market, getting responses. And we always say it's not when the going's good, it's when things go sideways or you really need a partner. That's really where Ion and my team steps in. We do provide that personalized service. And like I said, I would say with the 3, just my team lead, my underwriter, myself, we're close to 100 years in experience. Coming from the big bank, we got to work with, various lines of business, whether it be CMBS, life cos, we did balance sheet, but we got to do deals across the nation, and it really got, great experience under our belt. And I've been pleasantly surprised being in this market, which we predominantly cover New Jersey. It is just as busy, and just the clientele that we've been working with are Class A sponsors, Class A assets. So I feel no deviation from where we came from. It's just we have such a better platform to be able to execute and get responses back to our client. I think one of the most important things that we have is structure. We have a weekly call where we have access to all the decision makers, our chief lending officer, and each week we get to present our deals and in that forum and know on that call whether we're going to be moving forward with term sheet or where we need to fill in the gaps and go back. But it's a timely process. A lot of people come back to us because of our execution and our ability to execute. And a little bit about what I've been able to do since I've been at Ion is a lot of construction. So that was one of the big takeaways is I did more stabilized assets. And the construction world, I got to tell you, the experience and bench of our construction team, these people have been in the field, in the construction industry. So it's really elevated our conversations and be able to work alongside our developers and be a partner in the project, not just a lender. Some of the benefits of working with us on the construction side, again, because of the team, is just being able to walk through those budgets with our clients, understand the timeliness of execution of the funding draws so that they can keep their projects going. As far as asset classes, I think a lot of banks can agree to this. We do a lot of multifamily. That's in the top tier of a lot of what we do. I would say we are, butting up against some concentrations there as, just because it's been a hot asset. And then your next category would be industrial, then mixed use and retail. And retail, I would say, toggles back and forth. Again, it depends on the sponsor and where the property is located. But they've, been performing well, especially when they're service industries. And that's, again, a lot of times clients will come to us where there's a value add opportunity. We like those opportunities, especially with experienced sponsors who've been able to execute and do it before. And the good news is for borrowers and people who are on the market, I just got an email this morning. Every quarter, the Fed does a survey to the senior loan officers. It's a survey that goes to about 80 banks, 24 corresponding banks. And just this last quarter, it was in April, the survey went out. And I think it's timely to note this was in between the time of Liberation Day where tariffs were going to, were being rolled out. A lot of people have been asking, what is the impact? Well, I'm going to just look down for a minute because I want to be able to quote these numbers correctly. But the shift is 9% of the banks reported tightening as compared to the prior year. It was at 67%. So you can see that difference, like I said, from 67 to 9% in a short time frame. That's just making it more competitive. You're going to see for the right sponsors and, like I said, projects, the pricing spreads have tightened, which is making it very competitive, like I said. And then in addition, we haven't seen Fed reduction in rates. But we do anticipate that later this year. So the perfect storm of the rates coming down, more banks online, you should see the cap rates start to compress as well and values go up. So I know that's good news because, like I said, getting some extra equity in there is always good. But like I said, I would say for what we're seeing is very busy, a lot of looks, a lot of things are converting at this point and moving forward. But like I said, it's been great at a bank like Ion because like I said, we have a stealth team, a great process. And again, with the construction project, more recently, we just completed a multifamily project for a developer in Newark. This project had a pilot. He was able to execute, within a 12-month time frame, already leasing up, and we're looking at the next project. I think it's important to note for our size bank, we're about 2 billion. We were 2 billion prior to the most recent merger with MVE Bank, which is out of Bergen County. So as far as our target market, we cover Bergen, Morris, and Passaic. We can cover most of New Jersey, but those 3 counties in northern Jersey are our target market. And as a community bank, we are tasked to do so many loans within those 3 counties. And the more deals we do in those counties, it gives me the ability to execute outside of the market. So, like I said, we have a target focus in those areas. They're great areas to be, like I said, looking for those type of multifamily projects, whether it be industrial, anything to do with community development. And I think I'd be remiss if I didn't add, outside of construction and commercial real estate lending, we are a full service bank. So we can do lines of credit, we can do CapEx. So if you are doing an owner occupied real estate transaction, we can do it, whether it be conventional or even we have access to the SBA programs, both 7A and 504. So again, just wanted to, I really appreciate the opportunity to share about Ion Bank. It's a great, like I said, mutual bank. Even though we've only been in the New Jersey market for a short time frame, we are committed to this space, and that's evidenced through the most recent acquisition with MVE. So MVE, like I said, based out of Bergen, they have about 10 branches. We had 2 in Morris, and we have 20 in Connecticut, which is where Ion's headquartered. But like I said, new to this market, but our brand is getting out there, and it's forums like this that is a great opportunity for us to get the word out. So really appreciate you guys giving us this opportunity. So Ian, I'm going to kick it back to you. I don't know if you guys have any questions before I proceed, but like I said, really appreciate the opportunity to give that plug.
Thank you. Just one quick question. Your sweet spot of deal size, what is the range?
Oh, thank you for asking. I would say it's in that, I know this may be a wide range, but 5 to 7 million. But I think it's important to note, great question, is I can do deals, our legal lending limits just above 34 million. But like I said, that 5 to 7 gives us runway with our clients. But we have done deals as, over 25 million. And then we've done deals under 1 million. I did a mixed use construction deal in Riverdale for 600,000. So that's the benefit of also working with a bank. I know, like I said, I've been at other institutions where it's very segmented and you kind of get passed around. I like to use the analogy that I'm the concierge, the waiter, the chef, and the busboy. I'm here from beginning to end. So like I said, it does really allow consistency and allow us to execute, like I said, well.
Excellent.
Great question.
Okay. Yeah, thanks. Thanks so much for joining us today. It's my pleasure to now introduce our keynote speaker and my friend Lawrence Smoler. Lawrence is a proven distressed and performing real estate senior executive with more than 38 years of experience. He is vice president at TRIGILD, a national property and asset management firm that handles complex receivership and bankruptcy assignments. He oversees property operations in the Northeast and has served as an adjunct professor at Fordham University and holds a master's in real estate investment and finance from NYU. Lawrence, welcome. We're excited for you to share the ABCs of receivership and what you're seeing in this interesting market. Thanks. Thanks for joining us.
And thank you, Ian. And so again, my name's Lawrence Smoler. I'm a vice president and asset manager for TRIGILD. We're a receiver that runs nationally. So I don't know if anyone knows what a receiver is, so I'll just start with that. In this context, real estate context, when a borrower is starting to have trouble paying back its loan, for whatever the reason is, there's current payment problems or maturity default, whatever the reason, and the bank has made a decision that it's time to get control of the asset and see if they can recover as much as they can for the investment they made. They start a foreclosure action. So you have to go to court and start a foreclosure action to get control of the property. And especially in and around the Northeast, that's a long process. Getting the court dates, getting the objections approved, motions, etc. But when that's happening, the property usually suffers. So the idea is that the lender goes in looking for control and asks the court to please appoint a receiver, somebody who will look after the property while this argument in front of the court is going on. So When a receiver gets appointed, that's us, TRIGILD, as you know, for the assignments that we have. Our job, and it's a court order, it's filed, it's public. The filing states what we can and can't do, but basically at the end of the day, we're there to collect the rents and make sure that the dollars that are being collected get put back into the property. At the end of the day, we're looking to right the ship and add value in a time where that is difficult while there's a argument going on over control of the property between a borrower and a lender. So that's a very layman, quick term of what a receiver is. For you, when you hear receivers coming to a property, what does that mean for you? And my view is that it's good news. Before there's a receiver, if you happen to be aware that there's a financial problem going on with the building lending wise, and if you're a broker and you're wondering whether or not you should bring your tenant to that building, and whether or not, one, you're going to get paid a commission if you're the broker there, or whether or not your tenant is going to get the services that they expect in a building, you have a right to worry. But once a receiver's in place, and it's the receiver making the decision on whether or not we're going to be doing that new lease or that renewal, et cetera, and committing to dollars. These are, to put it simply, these are all court ordered and approved. You're going to get paid your commission. You're going to get paid the TIs are going to be paid, and the services in the building. The expectation is that they're going to be taken care of and looked after. So I'm putting it out there that it's good news to hear that there's a receiver on a building if you're looking to do business with that property. Not necessarily good news for everybody involved. Receivership happens in the court, as I mentioned. In general, it could happen either in a state court, and that's mostly where the receivership gets filed, but also federal. So I'm going to give you my view of state versus federal in a second. But before that, let me just go back up and give you more of my background. So I was a real estate broker first in the business through the 90s. Just out of 1987, where actually when I came into the market. 90s, I got into the commercial market. It was the first downturn that I was aware of. You had the RTC days. I was involved in that, and where I was involved is that I was in downtown Manhattan working for a large national management company who was getting assignments from lenders who took back their buildings through foreclosures. So I was an asset manager there during distress. I saw that cycle. I was in the cycle in 96 when the LTC long-term capital issue happened, right after 9/11, obviously in 2007. The difference between all of that in 2007 is that by that time I had transitioned out of being a broker. I got a master's degree from NYU. I got a institutional job with a company called MetLife. I think you're sure all aware of, out of Jersey. We owned a tremendous amount of real estate throughout the United States. We had a $50 billion plus commercial loan portfolio. Great perch to be at. But then when the world fell apart in 2008, I was out looking for a new position. Loved my time at MetLife, just for the heck of it. If I would love to still be there, but if I was still there, I'd probably be an associate director waiting for the sub person above me to die before I can, or retire before I can move up. So what 2008 gave me was an opportunity to move up in my career. And I ended up at a shop that were a bunch of bond guys, who bought CMBS bonds. And at the time, I don't know if I'm starting to speak Greek to a lot of people on the phone, unless you've seen, the movie, The Big Short. I knew how to spell CMBS. That's all I knew about the business, and it was real estate. But I got a quick learning curve, and then I was there for 6 years. And by the time I was done, I was able to eventually, I felt, teach a course on CMBS. But what that meant was, I was with a group of guys who owned, people who owned the B piece of CMBS bond offerings. And if you own the B piece, you get to choose who your special servicer is. That's the term of the person who's going to take care of defaulted loans. I ran the REO desk. So basically, we were going to be foreclosing on a bunch of assets, and you had this bond group who all of a sudden had to be owners. So I was able to create an asset management group from scratch. We onboarded over $3 billion worth of real estate in the time that I was there. And by the end, Fitch rated us as one of the top recovery groups in the industry. So we didn't recover 100% on the dollar, but we recovered almost 60% on the dollar, which was 10% better than most of the market. Great perch to be at that time. I'll tell you what the similarities between the different markets that I mentioned before, 87, 92, right after 9/11, 2007, and what's happening now. You could feel the cycles. In 2007, 2008, depending on when you want to say the start of that last downturn happened, it took about till 2010, 3-ish years away, before the spigot started to turn a little, before there was a little bit of capital in the market, before, while there were plenty of buyers and plenty of people with money, before banks and lenders and servicers were able to start transacting. They got their ducks in the row. They positioned themselves correctly. The market, as in general, discounted all the distress, and now it was time to move on. Clear out the books, allow for more capital to lend, and as you all know, we kind of got out of it. And then from 2015 to 2020, I think the world was pretty good again. Lending was easy, rates were down, and then we all got hit, as you know, with COVID, something that was unexpected. But I would tell you, in 2019, it felt kind of frothy, like there was going to be a correction coming anyway. However, COVID certainly made that happen. The position that I have now at TRIGILD, I took in August of last year. I was expecting this position to be available June of 2020. But just like what happened in prior cycles, it took a while for banks and lenders to get their ducks in a row, to figure out how the market was going to react to any moves that they might make, et cetera. And that's where we are now. Where we are now is the spigot has started to move. Where I say the spigot has started to move, when I started at my position in August, my company had between 100 and 200 assignments. Since that time, we have a 60% growth. In 10 months, 60% growth. So in that little microcosm, you can tell that the business is booming on the foreclosure side. That means that banks are starting to move on assets that they were weary about doing that in the past, which is all, again, I'm saying good news. Because if the stressed assets are starting to be able to be moved, that means that Christina can start putting out some new money to help people purchase these properties. The new buyers will add value. There'll be new refinancing and so on and so forth. We'll get into the next cycle. I was back at the federal versus state court. I just wanted to give you that I have a pretty decent background, and this is my own opinion on federal versus state. State court is not, it's harder to sell a property during the receivership in state court. In federal court, it's easier to do that. So my first case, and these are all public, when you find out the property is in foreclosure, is it state versus federal? If it's federal, your first clue might be, maybe there's actually an ability to buy the property now before the foreclosure. And state, a little less. The other thing about state versus federal, if you have a portfolio, if you're a lender with a portfolio that has properties that go over more state lines, you have properties in Jersey and Philadelphia and Florida, all in one loan package, then also you need to go to the federal court, because you can't, one in New York can't necessarily foreclose on a property in Florida, but a federal court can do it all over the country. So that's state versus federal. If that was meaningful for you at all, I thought I'd throw that out. How can you find out about which properties are currently in distress and where they are right now? If I'm assuming a bunch of people on this call have CoStar, you may or may not know that CoStar has been getting trapped data for the past, 3-4 years. There's a tab for loan and another tab. So CMBS public loans are being reported within CoStar. You're able to see servicer notes on a quarterly basis on what's going on. It'll tell you that we just moved this property to a watch list, and now we actually moved to foreclose, or we brought it down into special servicing. All of those notes are sitting there right there. For private lending and for banks, you're not necessarily going to see that, but if you didn't know that was out there, it's out there. So receiver's job is to right the ship, add value, and allow for as much recovery as possible for whoever ends up with the property. Sometimes the borrower ends up back with the property. More times than not, the lender is going to end up with control of the property. While that's happening, it can take as little as 6 months, not usual. Probably on average a year and a half before that happens, assuming a bankruptcy doesn't pick its head up on this. So a year and a half of having somebody actually look after a property that hadn't been looked after properly for the past couple of years allows for a lot of problems to get solved. So by the time the property is on the market for the next owner, it's in a position to just move directly to a profitable position. I have a couple of anecdotes that I could talk about, but before that, I'm wondering whether or not I should stop here and ask for any questions.
Thanks, Lawrence. Great insight, very, very timely. So the one thing you shared, which is you get involved with the receivership case, and it could be 18 months to get to the finish line potentially, right? And we have a lot of transactional people on this call on, oh, the property's in receivership. I should get in touch with the receiver and see where there's an opportunity, and can I start showing the property? Just when you evaluate strategy, it sounds like you're providing recommendations to your client who's the special servicer. In some cases, it may be, hey, let's lease up some of the space. Here's a budget for tenant improvement dollars. Here's CapEx we need for common area lobbies and bathrooms. Is it that involved that you would think a distressed property, you're righting the ship, but there's access to resources from the special servicer to, some people say, why are you putting good money into a bad deal? How do you assess and determine when you're going to ask for money to improve and stabilize the property to get a better result, even if it takes longer?
Got it. So life safety items, your leaky roofs that are going to cause even worse problems, those are just gimmies. You see those problems, you just take care of them. If there's income from the property, you're using the income from the property to take care of those problems. If there's no income from the property, then you're having discussions with the lender, and it's not a hard discussion to see that they would like to protect their investment and make sure that fire, life safety and other items are taken care of right off the bat. The next question about whether or not you're doing leasing and how much you're going to be spending on leasing. Are you doing 2-year deals, 5-year deals, 10-year deals? Are you paying commissions? Or how much TIs you can do? All has to do with what the lender's thought is about owning the building afterwards as REO on the books, or are they going to get rid of it relatively quickly and just let the next person do it? So what we provide is the options. We'll gather up, we'll do full assessments on the buildings. We'll certainly look to the people on this phone call to help us out with what the state of the market is for leasing. I'm going to take this opportunity to just segue a little bit from something I talked about before, which is about sales. I want to make sure I put it out there. For the most part, I'm talking about 99.9% of the time. Maybe I'm exaggerating a little bit. Property, if it does get sold either during the receivership or right after the foreclosure, it's going to be sold on a widely marketed basis. So almost all the time, as soon as I get an assignment, I start getting calls from brokers, people who know me, and I have an unsolicited offer. And immediately shut that down for lots of reasons, but I'll give a good anecdote on that in a second. But Yeah, the lenders have stockholders and they have the banks have investment committees, et cetera. And if you sell it for what seems to be a good price, someone's going to ask, well, how do you know that you couldn't have gotten $1 more? If you're on the CMBS side, you have bondholders all up and down the stock in the same situation. You sell what seems to be a decent price. You still don't know that is. So widely marketed is the way to go. One-off offers also, here's the anecdote. Had a property, we won't accept an offer, the lender won't accept, don't waste your time. They found a way through an attorney to the lender's attorney, pushed their way in. And the answer was, all right, listen, we're willing to buy this property at this number that is eye-opening. It's an eye-opening number. To the lender, to anyone else, it's eye-opening also because who the heck would pay that dollar? So you still have that in the back of your mind. But still, they said, I've been looking at the property for a year. My due diligence is done. I'm going to put down hard money. And I'm going to close in 60 days. And the lender said, your due diligence is done? They said, yes. You're putting down hard money? They said, yes. They said, on that basis, okay, we can move to the next step. What do you think the next comment was from that potential buyer? Can I have 2 weeks? Maybe two, maybe a month. I need a little more. I just don't know. If that lender was against doing deals then, for the next 10 years, they're never going to do an off-market deal. But that's basically the market. We've been through it in 2010 to 2015. We're going through it again. Off-market is very, very difficult to do here.
Great. No, that's really helpful. And I will tell you, you've given us a look under the hood of some intriguing aspects of receivership. We're going to have question and answers for the attendees. Please post it in the chat. And Lawrence, we're going to have you back to do a workshop in Q3 to tell us exactly what's going on in the market and, just to share some of the observations. But this was really a great introduction for many on receivership. So, thank you. And it's a perfect dovetail into our first panelist, Brian, who focuses on capital markets. And Brian, I'm sure there's a lot of crossover that you see in your space, but please just give us a brief overview of where you're focusing your time and what you're seeing in capital markets.
You bet. So as the managing partner of not only RePropCo Capital Advisors, where we're involved on the brokerage side, we're also through Doors and Spaces Industrial buying value add apartments and small bay industrial. So watching the different aspects of the market come together, especially over the last 6 months, has been interesting. And what you've heard everybody say together on this call is that we've reached an inflection point where the market is turning, activity is turning, the lenders are starting to lend, the capital is starting to flow, the distressed assets are finding their way to either be returned to health or to be sold to somebody who's going to do it at values that that work for all parties involved. And I always say there's 5 points to the capital markets star, right? So there's brokers, there's capital, there's owners, there's lenders, and there's sellers. And when the capital markets are running on every cylinder, that's the top of the market. But each piece starts to come together and has knowledge at different times, and we're right there. So when I watch it, the private capital comes in when there's entrepreneurial profit to be made, when there's risk to be taken, and they really don't have any investment committee or partners or structure to work through. They can move fast and they take risk. That's where we were the last 2 or 3 years. We have now moved into where the professional equity is starting to come in and say, okay, the private capital has made a footing, there's stability, there's transparency, there's visibility. I think the cap rates are stabilizing. I have, better than average confidence that I can go and get a loan from up and down the capital stack of lenders. And so we're going to go out and we're going to start buying some assets, because the worst thing for professional equity is they're too early and the poster child for doing something dumb. And the investors want to go somewhere else in the next cycle. We're past that with them. And as the professional equity starts to get more and more involved, and there's more and more transactional volume and more data points, then you see the institutional equity start to enter the market again. That's when you have the fastest cap rate compression. That's when you have the the fastest lending spread, that are coming in. And then everybody starts to say, okay, in that 5-point star, everybody is in tune with what's happening, right? So what have I been watching, right? The debt funds have started to really rush to lock in the deals they've been negotiating over the last month or two. Why? Because they see that the traditional lenders are starting to come in, and the spreads are starting to come in, and they're going to lose that business. And now is their time to lock in their profit, right? You're seeing the construction loan spreads start to come in. You're seeing agency loan spreads start to come in. You're seeing banks start to loosen up and pick where they want to be in asset types or sub-asset types. And then they're going to start lending again, and that'll increase through the spectrum, right? And now you're starting to, the more active buyers are starting to see the arbitrage between the sellers, the cap rates, or the cap rates that the sellers are now willing to accept, that they weren't willing to accept 6, 9, 12 months ago. Now they've hit that point to say, okay, this is where the market is. If I'm going to sell, I'm going to sell. And the buyers are saying, okay, that might have been predicated on interest rates 3 months ago, but today I know that I can get a loan 25, 50, 75 basis points cheaper than I was. Let's lock it in and let's buy. And you're seeing more and more transactional activity, especially on the buy side. And once the more sellers get in tune with this, and all those participants in that 5-star, then you start to see the cap rates move down, and we're just at the infancy of seeing these cap rates start to move and come in. So that's my overall take on the capital markets. I'll hand it back to you, Ann.
Thank you so much. Really appreciate that detailed deep dive. Chris Cervelli, Chris is a long-standing CCIM board member, a long-term friend. Please share what your focus is and an overview on the multifamily market.
Thanks, Ian. Yeah, Chris Cervelli, focusing on multifamily brokerage and property management in northern New Jersey. And I am a stats guy, so pulled up some numbers here. New York Metro, total inventory, 1,586,414 units. We have 53,570 doors under construction. Our 12-month absorption is at 30,203 units. Vacancy rate stands at 2.8%, and the current market asking rent is $3,310. So what's happening in my space right now? Sustained demand, limited supply, couple that with elevated interest rates. This has made it a difficult market to read. For renters, I don't see any relief coming. The political will to change legislation to create more units, it's just not there. I almost get the feeling like politicians don't want new constituents who might differ with their opinion. So I really feel like they're really putting a lot of the brakes on this affordability thing. Higher material and labor costs, builders are less incentivized to start a new project. So evidence being, we are at the lowest delivery of new units since Q1 of 2015. That's not going to solve the problem that we have of affordability. So for owners and investors of this product, rising insurance and utility costs, along with, again, the continued elevated interest rates, it's a risky sector. I think a lot of the owners who purchased just prior to and during the valuation surge of COVID are now having a real problem refinancing. And I am curious to see how these local banks are going to, there are several banks that are overweight short-term multifamily debt, and I'm curious to see what that looks like the next couple of years. To Lawrence's point, it took several years in previous cycles for them to kind of work through this and come around. And I just feel like a lot of the loans written over the last 5 to 7 years are underwater. I know that a lot of the banks, I'm hearing that they're getting these extensions, but that those extensions are not really taking into account the loan to value ratios. So I think that's, if some sort of regulator or something comes in, that's going to be a problem for the banks, and how that sort of, I hope that that doesn't stop the liquidity, because, and I agree with everybody, everybody wants to buy, everybody wants to do deals. I just hope the liquidity stays there to keep that juice going. But look, the rents are still going to be under pressure. There's just not enough units. Continued operating expenses increases is going to eat into that, but it's tough to be a renter right now. So yeah, that's it. If there's any questions, if not, that's my report.
Thank you so much, Chris. And I do see some questions coming in the chat, and we'll get to the Q&A before we wrap up today. And finally, Al Holloman, another longstanding CCIM board member. Please share your specialty and what you're seeing in the market.
Thanks, Ian. Yes, my name's Al Holloman. I'm an associate broker at RM Friedland Commercial, based in Westchester, and we transact in the boroughs, Westchester County, and Southern Fairfield. And we're a full-service shop, and I specialize in investment sales and leasing, primarily in Brooklyn, Queens, and the Bronx. So, like everybody else, our asset group has been plagued with the same issues of high borrowing rates, supply chain issues. But over the past 5 years, during the pandemic, the industrial has held its own, and it's been the top performing asset group out of what we see in the marketplace. And that's largely driven by e-commerce, increasing demand for last mile delivery, need for storage and warehousing, and a lack of inventory. So to give you a couple of metrics for the first quarter of 2025, in the sales and leasing activity, we had a total of approximately 290 million in sales, which reflects a downturn in volume from the previous quarter. And by borough, Queens has been leading with upwards of 180% year over year. And then you have Brooklyn, and then followed by the Bronx. Median price per square foot is at $430, and approximately 60% of the purchases were by end users. In terms of any standout deals, there was a $60 million sale of the Smyrna ready-mix concrete factory in Flushing. So, targeted investments are active, and, that's an indicator there. In terms of leasing activity, we saw a 16.5% surge from the previous quarter. Again, I'm looking at first quarter of 2025, and there was over 560,000 square feet leased, and that was driven largely by mid-size and small deals. And when I say mid-size, I'm talking 100,000 square feet or less. The smaller deals are typically in that 10,000 or less square foot range. Notable leases in boroughs, Con Edison did a deal in Red Hook, KCI Auto Parts, and SpeedX in Queens, and each of these were over 50,000 square feet of space. So availability crept up. Staten Island and Bronx are sort of on the lower end of things, and there's more vacancy there. But Northeast Queens, and Northeast Queens being Flushing, that had the tightest market, I should say, at 5.2%. I mean, typically in the boroughs, you'll see a lot of inventory, or I should say a lot of activity in the Long Island City, in the Flushing area. And it's mainly due to the fact that the transportation hubs are there. And so they've been the leaders in the activity over the last couple of years. So in terms of pricing, asking rents are down to approximately $27 a foot. But year over year, that's an increase of 6.7%. So it's a sign of ongoing demand. And again, Northeast Queens, the Flushing market, has led the way. In terms of construction, that's relatively muted. We've got a 1.7 million square feet that's currently underway. And again, it's mostly concentrated in Queens, where you have developers like Wildflower and Inova Property Group who are looking at a couple of projects there. So again, Long Island City, there's 1 million square feet that's currently leasing, which is a mixed-use facility, which is logistics and a film production studio. And then there's also another facility that Innovo has that's under construction. It's 350,000 square feet. Wildflower, they have 2 projects in Queens as well. One is in Astoria, which is a completed film production facility. You know, again, it's not your typical use, but it's something to take note of. And then there's also a 500,000 square foot logistics facility along the Whitestone Expressway in Flushing that is currently leasing. In the Bronx, you do see a couple of logistics centers that are off the Bruckner, so you know we can't leave the Bronx out altogether. But Queens is definitely spearheading the charge. So in summary, you know, the factors that are continue to have an effect on the industrial sector are going to be the increased borrowing rates, supply chain disruptions, tariff conflicts, geopolitical uncertainty, and the thing that's unique to the boroughs is the zoning changes, which are promoting more residential development. So that's a problem because over the last 20 years with zoning changes, you've seen a lot of the industrial product replaced by this frenzy of residential development. So that's going to continue because as was mentioned earlier, affordable, you know, there's a need for that, and every administration comes in touting affordable. So that's pretty much my take on things. Before I leave or before I sign off, I do want to mention or acknowledge one of our esteemed members, Paul Fetcher, passed away last week, and wanted to acknowledge Paul because he is one of the founding members of this chapter, and he a trailblazer by every metric, and you know, has done a lot for this chapter, a lot for real estate. His company is called the Great American Brokerage, based in Long Island. So just wanted to make mention of that as well.
Thanks, Al. And
thank you.
For those that knew Paul, he was the restaurant king. Not only could he tell you every restaurant or get you into every restaurant, he sold the Copacabana Club in New York City. He was involved in a deal on Tavern on the Green. A fantastic guy. I just want to thank you for that great insight on industrial. And to put things in perspective, when I started in my real estate career as a street broker on Long Island and I did industrial deals, I then moved to New Jersey. And I remember telling prospects on Long Island, you're paying $6, $7 a foot triple net to be in Port Washington or Roslyn or on the Route 110 corridor. Come to Jersey. You can be at $3 or $4 a foot triple net. So when I hear rents of $27 a foot and I hear sale prices of over $400 a foot, you know, New Jersey at $15 to $18 triple net and sale prices of $200 to $250 a foot, which I thought were crazy, now look cheap. And you can even find really well-priced space. If you go up to Syracuse, there's this guy, Brian, who has small bay industrial, and he'll do a deal sub $15 a foot. Right, Brian? We got a chance to do a deal at that price point. But great insight. And with 10 minutes to spare, we got a couple of questions, and I'm going to share them. And Lawrence, the first 2 are receivership related. Question number 1 is, can the receiver assign a broker to sell or lease the property?
So again, the court orders can tell you what the receiver is allowed to do and not allowed to do. Certainly leasing, almost every time leasing is discussed, and the lender has final decision about who you're hiring for the property. Sometimes the court needs to actually approve who's being hired for the situation. So at worst, we're a heavy influencer on that decision. At best, we're making the decision.
Okay, great. Thank you. And as a receiver, what are your legal bonding and insurance requirements?
It depends deal to deal, but again, it's in the receivership order as to what we need to be bonded for each property. for each
Got it.
assignment.
Okay, great, thanks. Next question, Chris Cervelli. In your opinion, should investors be focusing their energy on New York or New Jersey?
I think for cash flow right now, you probably want to be in New Jersey. I think the metrics make more sense. There's slightly less political uncertainty. However, New York's starting to get cheap. Prices are coming down. You can find stuff like 9 cap in New York Metro. So, you know, if you got a long road ahead of you, you might be getting really good deals right now. If you can, you know, buy cash and just wait and wait for that cycle to turn. This might be a great time.
Okay, great.
Ian, what are you seeing in the auction space?
Yeah, no, thanks for asking. You know, it's interesting. I've been involved in auctions for a decade. It's hard to believe the first auction deal I did was in 2015. And I was recently out in San Francisco and I saw a poster for OpenAI that OpenAI was founded in 2015, right? We all think of AI as being 2 or 3 years old, but you think about what the next 10 years is going to bring. And the reason I say that is a lot of people think of auction as the old school Cadillac, right? I was doing a webinar yesterday and I shared that when you think of real estate and auctions, people think of last resort distress, functionally obsolescence. And there's this guy, Ken Griffin. He's the CEO of Citadel. And Ken Griffin likes auctions. And in 2021, Ken Griffin paid $43.2 million for a copy of the Constitution in auction. And last year, he paid $43.6 million for dinosaur bones. And I'm like, we sell real estate. We sell bricks and mortar real estate. So online live bid, which is my mantra, is definitely becoming more mainstream to sell property using a technology-fueled marketplace. So it's very different to old school auction. As a company, Marks & Millichap National Auction Services, last year, we sold 25% of every auction deal in the US across 10X, Real Insight Marketplace, and Crexi. This year, we're seeing good velocity. We're at a exceptionally high trade rate of what we're bringing to market at 88%. We're averaging, Chris, over 10 fully approved, vetted bidders per deal. Mid-year, I just checked our stats. We're in a 2-day live bid auction, we're averaging 15 bids or offers per deal. So we're really getting true price discovery. And as Lawrence mentioned, with the ramp up of maturity defaults and receivership opportunities, we're anticipating a very busy Q3 and Q4 as lenders, you know, open up the spigot and want to get properties off their books. So I appreciate the question. I'm optimistic. I think we all are by nature. I'm just going to check Q&A. We are good. And we're going to put 6 minutes back on everyone's calendar, right? So go get that coffee. Go do some exercise. Thank you to all our presenters and for all you that joined today's program. Have a great summer, and we'll look forward to the next webinar after the summer in fall. Have a great day. Take care.
Thank you, Ian.
Thanks, Ian.